index, which is up down 50 points, 60 points, 59,455. And the small cap index, which will come up on your screen as well. And they're about a 20-odd point change. So again, it's absolutely flat. A little high, skewed to the positive side, the advanced decline. So 1,050 higher out of the gates, but this will change 600 stocks lower. Yesterday, the market breadth was negative. Numerically, the number of stocks, if you just looked at what was up and down. Heat map, more down than up, but not a lot. So 25,446 is where the Nifty is starting at, about 13 points, 15 points lower. Surabhi.
Okay, Titan is not sparkling this morning. Look at the cut on the stock. It's almost 4.5%. That is the big news and the big mover of the morning. Titan, the issue being this 18% growth in the jewelry business. The market is not happy. And some of the notes are pointing out that the base was also relatively lower. So on a lower base also, if you're not delivering faster growth, then it's a problem. So that's the one big headline. Other than that, on the weaker side, some pharma names, Dr. Reddy, Cipla, Sun Pharma. So pharma is a little soft this morning. These stocks are down about 0.5% each. There is some weakness on ICICI Bank, on L&T, on TCS. These are some of the heavyweights which are all dragging on the lower side. But now let's see what's up. Kotak Mahindra Bank reacting very well to its Q1 updates. Kotak is the best stock on the Nifty this morning, 3.5% higher. Tata Motors actually reacting positively. Perhaps, the market taking that JLR weakness in its stride, not as bad as expected. Eternal, ONGC, Wipro, and Jio Financial Services. These are some of the other stocks moving. But with all of this put together, Nifty is moving a grand total of about 13 points at this time. 13 points lower this morning.
All right, there should be a couple of stocks, though, that are in focus. J&K Bank, that's one of the big volume gainers this morning, so that's doing pretty well. Titan, as you said, was under pressure, but it seems that on PN Cargill, at least the start is in the green. The retail segment revenue growth has been closer to 19.5%. So, that's doing a relative outperformance, is up 1% or thereabouts. Phoenix Mills, well, a mild green tick is what you're seeing. The quarter one consumption is up by close to around 12%. And the occupancy as well at around 89%. Nectar Life, that's the one that's the big loser this morning. We've got, that announcement that came in earlier today. They'll be selling their API formulations and menthol businesses for around 1,290 crore rupees. For the time being, I'm not sure whether it's valuations or the street doesn't like that deal or it ran up ahead of it. But that stock is clearly one of the big losers this morning, down close to around 15%. And aggressive selling is what we're seeing on this front. But the sector of the morning has to be textiles. Gokuldas exports flying away up 5.5%. Welspun India as well, more to do with the tariff news that came overnight rather than the Wimbledon Tulls. So that one, in fact, has also opened up well in the green this morning. So that's, I think, the sector to watch. Let's pull up a couple of paper stocks. I think JK paper should come up for you. These stocks actually had a big run in Friday's trading session. I'm not sure whether they're doing too much this morning, more or less flattish as we speak. So,
I just wanted to point out Kotak Mahindra Bank as well and just revisit those numbers. When look at the growth, scintillating growth from Kotak Mahindra Bank in the first quarter, 14% up on advances, 14.6% up on deposits. The CASA ratio has been improving as well and 4% higher. So wherever there's growth, the market is willing to take up notice and salute the stock. That's what Kotak seems to be looking at today.
Well, that's Kotak Mahindra Bank, 2231 is where Kotak is at this point in time. Gautam Dugar is with us, Head of Research, Institutional Equities at Motorola Financial Services. Gautam, welcome to the program. Good morning. Thanks very much. Prashant this side. Let's just start with what we've been talking about since last Friday, which is consumption, FMCG, but consumption broadly. And many have been sort of on the sell side pushing this theme, but it's not worked yet. Maybe it worked yesterday. It's been fleeting, to put it mildly. What is your sense? There are lots of factors aligning, and I think we know all of them. Perhaps this GST rate realignment, that 12% slab, perhaps will also help along with everything else. But what is your view? Will this part of the market make one money? And where exactly?
Hi, Prashant. Good morning. Thanks for having me. So when you talk about consumption, it subsumes so many sub-segments that it's very difficult to take all of them and paint them with one brush. So what has been happening over the last few years is that the low-ticket consumer staples has been struggling. And they've been struggling for last 3, 5, 10 years, not a recent phenomenon. Of course, it got broadcasted more recently. But if you look at the last 10-year compounded sales, growth of many of these consumer staple names, hardly one company or two company at max, if you stretch, would have done a 10% top line CAGR. And I'm talking about top line, not even volumes, right? So, and of course, the last 3-5 years have been very, very tepid. In fact, I won't be surprised if there are many stocks you will find which would have given zero returns on a 5-year basis. Like the bellwether stocks have done nothing. So what has actually happened is within the consumption space, the higher ticket discretionary goods, they've done far well. And which is where our stance has been for last 4 years now. And we are continuing with that stance. In fact, yesterday when we published our strategy preview for this quarter, we've made consumer staple weight zero in our model portfolio. We had a single stock as it is, that also we've removed. So all our consumption allocation in the model portfolio now resides in discretionary. We feel as we move from $2,800 per capita to somewhere close to $3,500, $4,000 over the next 4 to 5 years, the alpha that you will generate in consumer discretionary stocks will be far better than consumer staples. In fact, consumer staples volume growth, there can be some episodes of few quarters where the volumes might go up to 3% or 4-5% here or there. But from a slightly longer term perspective, I think the alpha and the absolute returns that you can generate in discretionary will far outweigh what you will get in staples. Having said that, staples will obviously provide downside support in a volatile market when market is in a corrective phase. But I don't think we are building portfolios for those kind of markets. So our stance remains intact. We prefer consumer discretionary or consumer staples.
Got that. Gautam, hi, morning. Great to have you on. I remember that in your model portfolio, I think Titan is a stock that you've liked for a long, long time, right? Yeah. Now, when we talk discretionary consumption, even there, the market is hungry for growth. And say, for instance, I mean, if you just talk about the jewelry space, there are other companies, smaller companies like Kalyan and Senco. They're managing to grow at 25 or 30%. But Titan, I mean, at least this quarter, they're talking 18%. So what is happening with this industry bellwether? Is it just a temporary sort of realignment of sorts? Because the market's mood changes very quickly. And we're seeing some of that play out this morning itself, that they're hungry for growth. They might as well go for tier 2 jewelry stocks. What would your advice be to investors in this sort of situation? Trent is another classic example, right? Great company, great pedigree, but from a 50% growth rate, now they're doing 20%. And we remember how badly the stock was punished. So how should investors think about some of these high pedigree, marquee leader stocks if the growth rate starts tapering down?
So Surbi, just 2 points. On Titan, the size of Titan versus other jewelry players is 5 to 6x on revenues. And in some cases, even 10x maybe versus the smaller companies that you mentioned. So obviously, if those companies are growing at 25-30%, Titan's 18% is very respectable on that size. Plus, also remember the fact that 1Q FY26 jewelry prices, gold prices versus 1Q FY25, the underlying gold price inflation itself is more than 30%. So clearly, there is going to be some impact on volume here or there. Third, the sector's size is $80 billion. And sector over the last 10-15 years has been very consistently and gradually transitioning from unorganized to organized, which augurs very well for all the organized players. And of course, Titan being the bellwether leader of that industry will stand to benefit the most from it. The reason why we are positive on jewelry and not just Titan, some of the other names like P.N. Gadgil, etc., is the fact that the size of the industry, the TAM, gives us confidence for a very long runway of growth visibility. Today also, organized is hardly 40 or 45%. And if you go by the demographics of India, which we discussed extensively in your last Friday's editors roundtable, we have a very young demographic where wedding will continue to happen. And out of the 650, 700 tons of annual demand of gold in India, around 55 to 60% is wedding. So this industry offers tremendous growth visibility, of course, with a lot of intermittent volatility, depending on how the underlying gold prices behave. So we remain very, very positive and constructive on jewelry. Titan has been our long-standing top idea in not just jewelry, but overall consumer discretionary space. And our view has not changed. Coming to trend, that is where we've had a tactical positioning change in our model portfolio now. We've replaced trend with Jubilant FoodWorks. As you rightly said, for a company which is trading at 110, 120p, there's absolutely no room for error. I mean, if you view it in isolation, 20% growth on top line for trend looks very, very respectable compared to what the peers are printing right now for last 2-3 years. They're struggling to grow even at 8-10%. But the fact is, trades at triple-digit PE. So expectations embedded in that stock price were of 25 to 30% top line growth on a minimum, right? So therefore, 20% growth will look like a dampener vis-a-vis the valuation that it is commanding. So we think that it'll take a couple of quarters, and more importantly, not just the growth. We were a little bit surprised by the store additions for the quarter. Maybe there's going to be a bunch up, and obviously, whatever the annual targets are, they generally don't tend to be linear, more non-linear in nature. So story remains very intact. If I were to take a call on 3 years, there is absolutely no doubt that trend will form a very respectable allocation in my portfolio. But from a near-term tactical 3 to 6 months perspective, we think there's going to be more time correction that is that trend might see.
Interesting. So Trent makes way for Jubilant Foodworks. That's quite interesting. Sorry, 10 seconds. I'm taking from Nigel's time, but just 10 seconds. So Jubilant Foodworks, I mean, QSR, is that the only stock, or overall have you turned very positive on QSR? Quick 10 seconds and we're going to move on to other sectors.
So QSR has a very favorable base, plus incrementally, we think urban consumption is about to revive for a variety of factors that you already mentioned. And that's why Jubilant, being the only company with great market share, excellent delivery on cash flow, and a strong balance sheet, we think it's a small sector ultimately. You can't have too many stocks of QSR space in the model portfolio. So we chose the best one that we thought.
All right. Hi, Gautam. Good morning. Good to see you. And as always, let's talk about earnings then. Earnings season is going to be upon us in the next few days. Results will start trickling in. Q4 was great, actually, because expectations were so weak and then muted. And then suddenly, in fact, it looked better than expected. This time around, in terms of earnings growth, what are we factoring in? And for the year, what are you looking at in terms of Nifty EPS growth?
Good morning, Nigel. So yes, you rightly said, fourth quarter was the best quarter of last year in an otherwise very tepid full year FY25, which turned out flattish after 4 years of 20% plus earnings compounding in Nifty and close to 30% earnings compounding in Nifty 500. This year is looking much better compared to FY25 for a variety of factors. Government, RBI, lot of things have come together and they've given a lot of pro-growth measures, be it rate cut, liquidity, income tax cut, monsoon is good. So we think FY26 earnings will be far better. We are working with an assumption of close to 11-12% earnings growth for full year. To begin with this quarter, we are expecting 10% earnings growth for our coverage universe and about 5% for Nifty, which essentially means that as we progress into the subsequent quarters, and because we always prepare 4-quarter breakup right at the beginning of the year, the next 3 quarters we are building in about 13, 15, and 16% growth for our coverage and 6, 12, and 15% for Nifty. So as we progress further in FY26, I think the news flow around earnings will turn far better. Second, a lot of sectors are contributing. Last few years, we have gotten used to few sectors driving the growth. The interesting thing in FY26 and more particularly for 1Q FY26 is that the smaller sectors, which have hitherto not contributed much to the earnings growth, they are joining the party. So sectors like cement, sectors like retail, they are coming and printing more than 20% kind of earnings growth this quarter. Whereas the bigger sectors, auto, BFSI, IT, pharma, consumer durables, they're still struggling in that 4 to 8% kind of growth band right now. We expect financials to become far better as we progress in second half. The benefit of rate cut and surplus liquidity will start manifesting in their numbers from second half. So net about 10% earnings growth to begin with for this quarter for our coverage universe.
Talk about some 50% upside stocks, Gautam.
And 25%.
And by the way, I'm not joking. I'm serious.
So I'll give you an option: either stocks with 50% upside or stocks with 25% earnings growth. I'm making it very simple for him, right?
Absolutely.
So I'll choose Survi's question then. That's far easier. 50% upside stocks generally, Prashant, are known in hindsight. Just like
No. You give us 25% earnings stories, they'll give us 50%.
Absolutely. That's why I've chosen the easier path. Look, there are sectors like cement, EMS, where we are expecting very strong growth this particular year. Cement has struggled for last 2 years, and we are expecting pricing to improve, EBITDA per ton to grow 30% this quarter. While stocks may not have corrected much in FY24-25, despite very tepid earnings, but as you start seeing print of better earnings there, and of course, the underlying macro on consumption, capex spending by government has also given a bit of a hope. If you looked at the March and April number of government capex data, so cement clearly looks like a good bit. Second, EMS, there we are continuing to see not 25% but 50-60% earnings growth. Very difficult to find this kind of stocks in other sectors given the environment that we are living in. So if you look at it from a very top-down perspective, Prashant and Surabhi, we are slowly transitioning into an era where the nominal GDP growth itself will settle at 9-10% band now, because you've gotten a control over inflation. We are talking about 3.5-4% inflation and roughly 6.5% GDP growth. So nominal GDP, if it settles in 9-10% band, very difficult for corporate India to print more than 12-13% earnings growth in this kind of a environment. With that, of course, there will be a lot of stocks which will compound at 20-25%. There are stocks in retail sector where we are seeing more than 25% earnings growth for FY26. Then there are some pharma names, some consumer discretionary names, obviously, that we discussed about. So there are many stories out there for bottom-up stock picker and asset allocators to find that.
You mentioned Jubilant Food, Gautam, out of the, just completely published, nothing non-published, out of cement, EMS, etc. Which are those names?
So for example, in EMS, we are very hot on Dixon and Kate. Both are there in our model portfolio. So they have benchmark zero allocation in the benchmark indices. We have 4% allocation, right? In discretionary, as I was discussing with Surabhi a few minutes back, we have Titan, we have Indian Hotel. They've been part of our model portfolio for many years now. We have Page, and we've added Radico Khaitan. Again, very strong earnings growth there. Last 5 years, they've compounded earnings at 35%. Next 3 years, we are expecting 25% plus earnings CAGR. That finds entry in our model portfolio. And of course, we have Page also. So there are a variety of names. In fact, Prashant, while at it, I must also mention that we have increased the weight on mid-caps after a long time in our model portfolio. So till April, we had 76% allocation to large cap. We have brought it down to 69% because the mid-cap earnings are looking very strong. Last quarter, our mid-cap portfolio of 93 stocks delivered 26% earnings growth or 22% earnings growth. This quarter, again, we are expecting 21%. And as we progress for the rest of the 3 quarters, our expectation are 10, 25, and 20%. So mid-cap earnings are outperforming large cap by a margin of 2x. And therefore, while we keep debating on valuations, and valuation premium is there, everyone can see it, and it's been there for more than 3 years now. If this kind of growth continues, it's very difficult to imagine that that premium will.
And what are the new additions on the mid-cap side, Gautam?
So there are quite a few additions there. Jindal Stainless is something we've added. UTI AMC is a new stock. As I mentioned, Radico, Jubilant, they are new additions. We've added Lodha, Macrotech basically. We've added Niva Bupa. So quite a few allocations, new allocations. And of course, we've also gone, we upgraded our stance on auto, like we discussed a few months back. That auto is offering you a combination of reasonable valuations and modest expectations. So while we have not changed our stocks in auto, we've increased the weight on both M&M and TVS, which were already part of the model portfolio. But auto moves from underweight to equal weight now.
Very interesting. So auto moves from underweight to equal weight. And that's largely because of your focus on auto ancillaries, or just expand on that? Because again, auto, for the longest time, like FMCG, has just failed to enthuse. FMCG, you're not changing your stance. You've explained that. Within auto, what are you turning positive on now?
So auto, we already had M&M and TVS in our model portfolio for some time now. M&M,
which have already done well, Gautam, but anything new?
We expect it to do better now. In fact, this quarter also, if you go into the details, you will find that out of the 26 auto stocks that we are covering, the 2 best performers for this quarter in terms of earnings growth will again be M&M and TVS. Rest of the stocks, Maruti, Hyundai, Tata Motors, Bajaj Auto, they will print a negative earnings growth again in this quarter, right? So we are quite lucky to have chosen the right stocks even when we were underweight on the sector. So you're not changing the stock calls per se. Insofar as auto anchors are concerned, we think Craftsman, Endurance, and Happy Forging are the names where we have a slightly positive bias. But the change in stance in auto is primarily dictated by top-down trends where valuations are still reasonable, expectations are modest, and underlying trends on monsoon, income tax cut, inflation, all of them are giving a signal that at some point of time in next 1 or 2 quarters, things will start looking better for auto. So we are positioning for that.
Very quickly, Gautam, no conversation on the market can be complete without discussing defense, right? And the next company that we'll be speaking to is Astra Microwave from that sector. So just very quickly, Your thoughts? Prices have run up, but the order books are coming. Big order announcements are still coming. What's your advice to investors on defense?
We continue to like it. In fact, we've added Bharat Electronics now in the model portfolio in place of ABB. We also like Hindustan Aeronautics. The problem, however, is the stocks have run up too fast. What was our target price when we initiated HAL in March for 12 months was achieved in 1 month. In fact, as we keep highlighting this, the total market cap of defense went up from somewhere about 1 to 9 lakh crores in a matter of 3 years. And July 24 was the peak. Between July 24 and February 25, it came down by 35%. And then between February and June itself, it recouped all its losses and crossed the all-time high market cap. Right. So opportunity is tremendous. The focus of the government is there, and kind of geopolitical turmoil that we are seeing in the world. This sector will definitely merit attention. Just that one has to be patient and shouldn't expect a quick buck here. So if one has a 1 to 3 year horizon, I think we can still make money here.
But long term, yeah, don't look at quick gains because that
valuations have gone up substantially over the past 3 years, and more so post Operation Sindoor and rest of the geopolitical events that we have seen unfolding in the last 3 months.
Absolutely. So a little bit of caution perhaps warranted. Great conversation this morning, Gautam. Thank you so much for joining in. So we're all excited for the earnings season, and the expectations are that this is going to be a good one, and maybe we get out of that single-digit growth funk that the Indian market has been in FY25. Well, let's then continue that focus on the defense sector. Astra Microwave is the company on our radar. So let's figure out what the business prospects are looking like. There's a huge increase in procurement. They, of course, look at the space segment as well quite carefully and closely. We have Mr. Atim Kabra, Director Business Development and Strategy at Astra Micro, joining in. Mr. Kabra, great to have you on. So I just want to start with the focus on the defense part of your business. Just last week, we've got another big headline announcement, right? That the Defense Acquisition Council has approved proposals worth 1 lakh, I think 5,000 crores thereabouts. So in the new proposals and the replenishment program that's ongoing for the government, do you see any significant potential for you? Because you've told us, I'm just repeating, your FY26 revenue target, I think, is about 1,200 crores, which would be roughly 20% growth. Would you look at increasing this estimate, given the pace of replenishment that the government is speaking of now?
Hi, good morning, everybody. Good to be back. I think the government has done its part. Now the industry has to step up and deliver. A delicate balance has to be maintained between timely deliveries in an industry which has slightly longer life cycle, and homegrown tech supplemented by outsourced pieces which are missing tech pieces. So our numbers will go up, obviously, as the orders from what has been announced flow down into the picture. And but more or less, the larger programs which have been defined, they are already taken into account in our estimates. But we will add them to our order book as the orders are translated into reality.
So as of now, you're not looking to increase your estimates for the year. That's 1,200 crores of your revenue target. FY26 order booking target is around, I think, 1,400 crores, if I have the latest numbers. You're not looking to increase those numbers?
The announcements have to result in the orders flowing down to the the customers, and in turn, they will place orders onto us, right? And these are slightly longer gestation projects, so it takes time to actually for the cycle to flow down and translate into real numbers.
No, fair enough. But what the DAC announced last week, this was last Thursday, Friday, where they're talking about quick reaction surface-to-air missiles, all kinds of other, systems and subsystems. Yeah. So what is the opportunity size for you from that huge number of 1 lakh crore that was announced?
When we talk about, for example, QRSAMs, right? QRSAM, Astra will get about 1,800 to 2,000 crores, which we have disclosed in our analyst interactions. When you look at newer missiles coming in, if you have passive homing heads, which we are making, we are into missile electronics. Akash missile has been, we have supplied crucial subsystems to that. So space allocations, as you touched upon, right? Okay, there's in-space tender, which I think there are 4 or 5 consortiums which have bid for us, and we have bid. We are part of one of the consortiums. So these are all big picture programs which will translate into numbers as we go forward. So the order book will be increased in actual numbers as the orders are booked into the company. These are announcements of allocations which have been made right now. So,
All right.
yeah.
Mr. Kabra, just to reconfirm on the quick reaction surface to air missile, the potential order that you'll get is how much? And the order will come in from BEL, right?
Yes, please. We will get between 1,800 to 2,000 crores. That's our estimate on the QRSAMs.
And
supply chains need a lot of time to be perfected, right? So these are all things which have allocation is made. Then the BL, which is the main agency for this, they will in turn now intimate their suppliers, etc., etc.
All right. And by when do you expect this to come about?
I think could be last quarter of the current financial year, or maybe spills over into the next quarter of the next financial year, first quarter of the next.
When you talk about an opportunity of 1,800 to around 2,000 crores odd, your current order book itself is closer on 2,000 crores, which would mean that effectively your order book could double. So the execution timeline for this particular quick reaction surface to air missile, to which the order will come from BEL, the execution period will be how long?
3 to 4 years, I expect.
All right.
Yeah. The tech curve now is very steep, right? And it's the short end of the time scale. So we expect that more and more such programs will be coming up, which have a very crucial tech element. So where there's a huge barriers to entry for people who are not part of the supply chain or the development cycles. So we are fairly well placed.
So this is very, very significant, Mr. Kabra. What you're telling us is that almost 2,000 crores of orders could be flowing into you by maybe end of this year, if not early next year.
Yes.
Very, very significant. And this is just the QRSAM program that we've discussed.
Yes.
What about, say, radar systems, unmanned aerial vehicles, other aspects of defense where you're active? What else is happening there?
See, it's basically the war is now tech-driven. The government has done its part. Industry has to step up. We are talking about, do we have the complete tech elements built in from A to Z, right? So there has to be assimilation of the missing pieces of tech which have to go in. And it's not about just modules which are being procured and put together, right? So you have to go down to the base components wherein you will actually break up the products, the tech pieces which you are maybe outsourcing and procuring from outside, add them to what you have and create solutions and products, right? So this is an ongoing exercise. There are a lot of programs which are coming up, but as and when they are adopted, the airborne platforms, all the fighter planes are being upgraded.
No, again, we were sorry, sir. I'm rushing you, but because our next guest is also waiting. But we were again just trying to understand the opportunity size for Astra in particular. So obviously, this QRSAM program is going to be massive for you over the next year and a half.
Yes.
Apart from this, when you talk about other defense components on the electronic side, on the radar side, are you expecting any other, big orders to trickle in? What else could be a contributor to your defense revenue?
If Atmanirbhar Bharat prevails, if the DRDO designs on, let's say, Su-30 plane upgrades, if they prevail over other technologies on offer, then Astra is very much a part of the Virupaksh radar program. Okay, so we hope that itself will be a very, very big chunk of business for us, because there are more than 230 Su-30s which will need to be upgraded. So, there are MiGs which need to be upgraded. So airborne platforms are one. Radars are the backbone of modern warfare, as you very well know, right? So there are multiple radars which are being constructed at this point in time at various stages. You have triple LWR, the low weight, long range. Triple LWR. These are the radars. Bird detection radars are in the offing. The counter drone radars and.
What could be the potential business opportunity, sir, from this?
It's very difficult to put a number onto it.
Want to put a guesstimate?
These are all programs which will contribute substantial chunks of business every year. 300, 400 crores coming in lots every year, right? As you look at that.
All right, Mr. Kabra, very quickly before we let you go, everything's looking good from 1,200 crores. Probably in the next 3 years, you could do 2,400 crores. Probably double your revenues. Margins could be healthy as well. So give us a few numbers. In the next 3 years, where do you see your revenue move from 1,200 crores in this year? Where do you see it move? But more importantly, I wanted to ask you about your working capital days. That's got stretched very much. Cash conversion is very, very high. Tell us where do these numbers stabilize at, sir? Please go ahead.
The industry is capital intensive, right?
Yes.
There's no two things about this, right? But you have to also remember that the biggest chunk of orders, they are released in the last quarter, right? So
yes,
you may do whatever, but those orders will always reflect in your books as receivables, right? So as your sales grow, your receivables will keep growing, right? So the year-end number of March 31st is a function of the fact that orders are released in bulk in the last quarter, right? But capital intensive nature of the business is there and will remain. So if innovative ways of financing can be thought of, that's something which will ease. But otherwise, this is GOI credit, right? Okay, the banks should be more than happy to finance this. So we are not looking at this being a concern, but we need to manage our books very judiciously, the cash flows.
Okay, all right. We'll get into further detail when you declared your quarterly numbers, sir. For the time being, though, the street likes what you've had to say. The stock actually has moved to the high point of the day. We look forward to having a longer chat with you, Mr. Kabra. Well, let's focus on the consumption space. FMCG stocks are showing an uptrend as green shoots are becoming visible in consumption. In fact, FMCG companies have come out with fairly positive Q1 updates. So is demand recovery here? And what are the trends visible inside? To help us out with that, we're joined by Mr. Mayank Shah, the Vice President at Parlay Products, as well as Vishesh Dora, the Chief Growth Officer at Bizoom, who joins us. Hi, gentlemen. Good morning. Thanks a lot for joining in. Mr. Shah, you go first. Tell us, how are you reading demand on ground? First of all, break up your mix for us between urban as well as rural. How is consumption on ground? And are you seeing a good revival?
Firstly, if you talk about the contribution of rural, if you look at our product range, almost about 55% of our turnover comes from rural. So in terms of our stakes in rural, we have a substantial stake in, rural India. As far as consumption is concerned, we are seeing, good demand coming in from rural as well as urban India. So as we all know, last year was a little difficult one for FMCG and urban demand was under stress. But thankfully, we've seen revival happening in the first quarter of this year, this fiscal, and we've seen, urban demand reviving. We will see, further revival of urban demand as we go forward. And rural continues to be, strong. So we continue, we see continued strong rural demand. Given, both urban and rural good demand, coming in, we're expecting a good year this year.
All right. What would good be, Mr. Shah? What is the industry growing at and what are you growing at? Have you gained market share?
Yeah, we gained market share last year. Last year, if you look at the industry grew at about 5 to 6%, mid-single digits. We grew at high single digit at about 8 to 9%. And that, gave us almost about 80 to 90 basis point increase in market share. If we talk about this year, current year, we're expecting, as far as the category is concerned, at least a lower double-digit growth. We are expecting at least 12-13% growth coming in, despite of, the challenging, situation as far as the input costs are concerned. So, if we talk about crude, we've seen, spike in crude, although it's gone down now, but some challenges remain. So, given, last year was difficult as far as input costs are concerned, there was, for the most part of year, it was very inflationary. And if that sustains this year, then, that would be one challenge that we would be facing almost all food companies or almost all FMCG companies.
Guys, guess what? We could do with some biscuits here to go along with the chai right now. I think,
Consumption.
Well, a hint to the PCR team. Maybe. But gentlemen, thank you very much for joining us, Mayank and Vishesh. I just want to, Prashant here, I just want to ask both of you this one question. Many have made the point that actually it's not consumption which has been weak. It is just too much competition across product categories. An intensified competition, especially over the last 3 or 4 years. Mayank, would you agree with that? Or you think it's a combination of both? Or it's basically, it's we're talking about different categories. So, in some categories that could be the case. Others, consumption itself has been very low. What would you make of it?
That's partially true. So, regional companies are growing, smaller companies are growing, and they're definitely giving, run for their money to the bigger companies. However, if we talk about Indian market, I think, in terms of penetration, in terms of per capita consumption, I think we have a long way to go up, and that's something that, probably is the reason why you'd see that, most companies are very optimistic when it comes to, capex and other things. And not just that, even in terms of, growth and consumption, we're seeing a continuous increase and a continuous, growth coming in as far as, certain categories like foods and, few other categories, adjacent categories are concerned.
Okay. Vishesh, same question to you.
I think
Yeah.
I think largely great products are winning is what we've been seeing for the past couple of years. Of course, consumer sentiments are moving towards different kind of products. Distribution, of course, is a key node to win the market, but great products are taking the forefront. When you talk about, is consumption lagging? I don't think it's lagging. It's continuously growing. And we've been seeing great indicators of it, especially in urban. Right, large pack consumption is growing, out of home consumption is growing. Your smaller packs are not going that well in urban. Premium categories are penetrating deeper, right? So urban market is set for a great revival of consumption is what we see.
Morning, gentlemen. Vishesh, particularly want to address this question to you. The big debate that's out there that says that really D2C has disrupted perhaps structurally that huge distribution moat that a lot of FMCG companies had enjoyed, especially I think in things like personal care, right? Where consumption is happening through your Instagram and ordering is happening through that channel or through, the quick commerce sites. What would you say to that? I mean, the effects of quick commerce and the way we will see volumes play out and just competitive intensity play out in the staples space.
I mean, if we still compare the vastness of the nation, D2C is still early in penetration. It will truly lie on how they scale offline. Online penetration of e-commerce is still, lower single digit, if I may say so. Right. So we are seeing that impact in urban, where great products, again, like I mentioned, are winning. Young brands who are investing into consumer-centric products. What we also see on the other side is large brands also adopting faster, bringing in or entering into categories which are D2C heavy. But all in all, you have to be offline if you want to penetrate deeper into the Indian market.
All right, Mr. Shah, coming back to you then, if you could tell us what is your absolute market share? You said it's improved by 80 to 90 basis points, and if you could mention the category as well.
Yeah, so as far as biscuits are concerned, we have about 29% market share. And if we talk about confectionery, which is also another mainstay that, we have about 15% market share. Within snacks, we have about 7% market share.
All right. And what about quick commerce? Has it affected your channel strategy? If you could tell us, how much does it contribute in your overall share, quick commerce?
Quick commerce contributes about 4.5% to our, total revenues. And I think, as Surabhi was just saying, or she was checking, I think, that's one channel that is making a huge difference. So while, you talked about D2C is, good for niche brands, very premium brands. But when it comes to, value brands, or when it comes to, categories which are deeply penetrated, I think, the last mile delivery cost is something that's prohibitively high in India for most D2C brands to, really succeed. I'm talking about, value and mid categories. In niche categories, yes, you can do with that. Whereas when it comes to QCOM is something that, when you aggregate it and when you have aggregators, it makes a huge difference. And if you look at the growth rates in QCOM, we are seeing, almost about 40-50% plus growth rates year on year since last almost about 3 to 4 years in QCOM.
Well, okay, so gentlemen, as we wind down the discussion, we'll be happy to report that I think the Kirana channels are strong and they're thriving for most of the players because we've got our biscuits. Prashant, demanded and it has been delivered
that makes
right in the time in which the discussion is on. And there's not Q-commerce. This is a regular, general trade channel delivery and it's working.
Since it's appeared so fast, I'm thinking, what should I ask for next?
Don't push it. We have to be satisfied with what
I'll tell you in the break.
All right, gentlemen, thank you very much. Mayank and Vishesh, appreciate both of you coming in. Very interesting discussion and hope we can do more of this to get a real sense, a pulse of what's happening on the ground across, a range of topics, really. We'll come back in just a bit from now. Our special segment, Quarter Se Quarter Tak. Kawaljeet Saluja of Kotak Institutional Equities will join us to talk about expectations from the IT space that's coming up. Stay tuned.
Welcome back. Well, the next sector that we're putting the spotlight on is the IT space, and that's because it is time for the earnings season, and we are back here with our segment Quarter Se Quarter Tak, bringing you expectations from each sector day after day. Well, Rima kicks it off, of course, with the IT earnings. Rima, so is there any good news in store first quarter FY26?
Well, unlikely. So you're not going to see the usual strength that we typically see in Q1 because so far the visibility on demand reviving is very low. So let's look at the early indications from the CNBC-TV18 poll. Well, large caps are showing weakness while mid caps continue to lead the charge. This is the large cap picture, and as you can see, 4 out of the 5 large cap IT companies are likely to report a decline in their revenue. Commentary across the board is likely to reflect that while the macro environment hasn't improved in the last 3 months. The good part is it hasn't deteriorated. Now a little bit more about the guidance. Now, Infosys is likely to raise the current guidance. It stands at 0 to 3%, but they made acquisitions, and therefore that guidance could be upped. If the lower end of the guidance is raised from the current 0 to 1%, it's unlikely to signal anything positive. It's the upper end which needs to move on an organic basis. Now moving on to HCL Tech. HCL Tech too could upgrade the lower end of its guidance. So 2 to 5% may become 3 to 5%. But here is where the good news comes in. Mid-caps are likely to outperform and very strong growth. Look at Coforge. That's been leading the charge in the mid-cap space, and we're expecting about a 6.5–7% kind of a constant currency revenue growth on a quarter-on-quarter basis. Persistent is close to about 3.5–4%, and that's been the revenue run rate, at least quarterly growth rates for Persistent over the last couple of quarters, 3–4%. That's going to continue. Hexafair and Emphasis also upbeat. So mid-caps are likely to report stronger growth, and this is led by some market share gains and favorable portfolio. For instance, a few mid-cap companies have a little less exposure to manufacturing. So that's the key, takeaway. Large caps weak, mid-caps will continue. Now moving on to the stock price performance. As we've been highlighting, mid-cap IT has underperformed. On a year-to-date basis, the Nifty IT has underperformed by nearly 17%. Valuations for large caps are similar to their 5-year averages. But then again, they've got muted revenue. Earnings growth is expected to be fairly muted for the large cap IT companies. So in that context, even if the valuations are not expensive, are they cheap? It's the mid-caps where you are seeing a valuation premium. Now, the mid-cap IT companies are trading at 32–33 times PE on an average, much about a 38–40% premium to large cap IT, which is at about 23–24 times. But that's because the mid-cap IT companies are also likely to report stronger growth. With high valuations are coming strong growth expectations. So this is the EPS estimates for mid-cap IT companies over FY25 to FY27. We spoke about Coforge's strong top-line growth this quarter of 6.5%. Well, they're likely to report a 38% EPS CAGR growth over FY25 to 27%. Hexafair Persistent could see about a 20% kind of growth, much higher than the single-digit EPS growth that large-cap IT companies are going to report. Now, what to watch from TCS, because that's the first one off the block on the 10th. Well, constant currency is likely to decline by 1.5%. The what to watch, the company last quarter told us that the international revenue growth, that's ex of BSNL, in FY26 is going to be better than FY25. Do they hold on to that? Does that commentary get stronger? And one puzzling factor for all analysts is that, margin expectations are not going up. And this is despite lower contribution, reduced contribution coming in from the low margin BSNL deal. So why is that not happening? Why are margins not expanding for TCS? And also, if you remember, last quarter, they decided to defer the wage hike. So the timing of the wage hike will be watched very closely this time. Back to you.
All right, Reema, thank you very much for that. So very, very good explanation as far as the IT sector companies are concerned and what to expect. Coforge, top of the list. I remember Coforge last quarter as well. I think the stock moved 8–10% after earnings. Expectations are equally strong this time around as well. Kawaljeet Saluja is Senior Executive Director and Head of Research at Kotak Institutional Equities. Kawaljeet, good morning. Great to have you with us here. Thanks for your time. So let me just get straight to the point. In terms of stocks that you track the entire gamut of companies there. But with regards to exceptional performers in a weak environment, it's very, very clear. It is, 2–3 of these mid-cap companies. Why is that, Kawaljeet? And, can some of the larger players start to do this as well? What would you be focused on?
Large companies may not replicate the strength shown by mid-tier companies. They have a few things working in their favor. First and foremost is the portfolio mix in itself. As Reema did highlight that many of these mid-tier companies do not have manufacturing and relatively modest exposure to retail. So that will help their growth in the current environment. Second is that they have the benefits of lower size as such. And third is that they can use Gen AI in a lot more proactive way rather than think about the deflationary risk to the portfolio. So as long as you have the right leadership and these mid-tier companies, it's reasonable to expect that they'll outperform some of the larger companies as such. Large companies, of course, again, they have a portfolio challenge in the current environment. And of course, there's some deflationary risk of Gen AI that they have to take into consideration. So this divergence in the performance would continue.
Folks are just pointing out sometimes brokerage notes can have very interesting titles or even stocks. I remember Nomura's note, categorically from last week, they called out Tech Mahindra as a marquee sell. Like marquee, I thought would be something which would be, positive, saying a marquee name or whatever, but it's a marquee sell. But anyway, I think Kawaljeet actually likes Tech Mahindra. Kawaljeet, hi, morning. So that brings me to the overall question on large cap IT, because you still, like stocks like Infosys or TechM. What's the reasoning? What's the rationale? Because the companies, to be fair, have been disappointing investors on growth for a long time. And even in Tech Mahindra, that whole improvement of the margin trajectory, that seems to be just taking really long.
Well, I think they had outlined FY27 as the year in which they are going to get to 15% EBIT margin. And I think they're pretty much on track here. So I don't think what the concern should be. I think even in the current quarter, even though their revenues would be muted, they will continue on the margin expansion trajectory. In a turnaround journey, what happens is that there's too much of emphasis on what happens in one quarter rather than the entire journey in itself. And if you look at Tech Mahindra, the kind of improvements they have, the changes they have made on the leadership, the internal process, the deal filter, the structuring of deals, the TCV, I think they're pretty much on the right track on the turnaround journey. And that gives us comfort, on the story as such. Now, of course, if you're going to live by the quarter, then yeah, maybe the current quarter may be modest in terms of revenues. But again, you'll have a decent margin performance here. So it's just that overall makeup, we have to basically look at it. We are pretty much comfortable with our...
Okay. That explains Tech Mahindra, but sort of the bigger question on large cap IT, there's clearly, you have conviction on Infosys, maybe not so much on TCS. Both the companies have not really blown the lights out in terms of growth. What makes you still optimistic, and why more Infosys than perhaps TCS?
I think it all boils down to a top-down view on what happens to the overall tech spending. Like, let's say if you take a directional view that tech services spending would remain weak, the way it is right now, then the pessimism on some of these large companies is justified. But I guess, if the assumption is that at some point in time, the spending picks up, which our belief is that it would pick up, given that there's a lot of core modernization, data modernization journey still left in the large, for our clients. And I think that's something which many of these large companies will drive. You can basically expect, a reasonable growth. So at some point in time, there'll also be an uptick in discretionary spending. Our assumption was that things will start improving in FY 2026. Of course, that got scuppered with the tariff imposition, which means that normalization of the growth journey got deferred by a year. So now within this context, what you have to look at is that which are the companies that are executing well, and which are the companies that can capitalize on the ensuing opportunities. And I think that's where our confidence in Infosys comes in.
Okay, all right, Kawaljeet, quick conversation today, out of time, and hope you join us as we review some of these earnings as they start to come in very soon. First of the block, that's the IT pack, as always. Kawaljeet Saluja at Kotak Institutional Equities. We'll take a quick commercial break here. What we're going to do is come back, take a look at what's happening as far as markets go, commodities in focus as well. Stay tuned. Okay, welcome back. Let's shift focus to what's happening as far as commodities go. Manisha is here with what is top of mind. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, I'm looking at metals as a sector because we've seen a decline continue across the screen for a second straight day, by the way. The month of June was good, but July really hasn't started on a very positive note for many of these metals. Well, one is the higher US trade will take effect from 1st of August. Now, it just keeps getting stretched, so there's no clarity, especially when it comes to copper. We don't know whether it's going to be in the same line as aluminum and steel, which are tariffed by nearly 50% there. So that also seems to be bothering the copper prices there. Also, markets are grappling with steep tariffs. Letters from US have gone to 14 countries there. It also has to do with the US dollar index, which is holding at around 97.5. Also weighing onto the markets. Strong US jobs data continues to support the US markets as well. So all of that has led to money shifting into other assets, and base metal prices have seen a bit of a decline. Take a look at copper then, and pardon me. Take a look at copper prices, and we've seen $9,800 onto that one. We did see $10,000 a ton also hit in the previous week onto that one, but that doesn't seem to be holding at this point in time. The copper stocks, if you look at those, have seen a very sharp decline. They just are at around 97,000, and we have seen copper stocks drop by nearly 64% from mid-Feb. Even after that, the copper prices have not been able to sustain above $10,000 a ton there. And it's not just about copper. Take a look at aluminum, zinc prices. We've seen 2% of a decline for both of these metals for this week as well. Palladium prices have come off their 8-month highs as well. If you look at platinum prices, well, they fell 2% overnight and are off their 13-year highs. The kind of that phenomenal run that we saw in the previous quarter in platinum, where we saw the prices gain up by almost 50%, now seems to be consolidating, even coming off because of some profit taking. The speculators also seem to be winding on their long positions, and that's very clearly seen because of the fundamentals as well. We're looking at production in South Africa mines continue to recover. Above ground stocks stand at 9.2 million ounces, and that is equal to 14 months of above ground global demand. So all of those factors also weighing on. When you look at the week-on-week, month-on-month basis in sense of many of these metals, platinum, palladium, copper, aluminum, zinc, all of them have come off their multi-month and multi-week highs.
Okay, all right. Thanks very much, Manisha, for that. Well, there's commodities in focus. We take a quick commercial break here. On the other side, it's a special segment. It's the economy. Trump's shot off letters to 14 countries announcing tariffs. Lata will be speaking with Robert Subramanian of Nomura and Chandresh Jain of BNP Paribas and the impact of these tariff letters on economies, currencies, rates, and more. Stay tuned.
Welcome to It's the Economy. President Trump's announcements yesterday are interesting. The high tariffs for the 14 countries have been announced via letters, which don't have the force of law, but the executive order, which has the force of law, has pushed the date when tariffs become effective to August 1. Asian markets have therefore taken the announcements calmly. Stocks are in the green. Emerging market currencies are also stronger versus the dollar compared to yesterday's levels, while, of course, US stocks declined and yields rose. So it was actually US markets which showed negative reactions. To get an idea of the longer-term takeaways from these announcements for emerging markets, I have with me Rob Subaraman, Head of Global Macro Research at Nomura in Singapore, and Chandresh Jain, Rates and FX Strategist for EM Asia at BNP Paribas. Gentlemen, good morning and thank you very much indeed for your time. Rob, how should we read Trump's behavior so far? The letters, again, sound like threats. They don't have the force of law. What has the force of law, the Vietnam agreement, was actually half of what was threatened. So should we assume that we will settle down at lower tariffs?
Hi, Latha. Good to be back. I think these letters that have gone out, countries like Japan, Korea, Malaysia are looking at a 25% tariff rate. I think several ASEAN countries, Thailand, Indonesia, and some of the frontier ones are looking at 30% or higher. But as you say, the date where they're effective has been pushed out to August 1. And I think the market is assuming that this gives more wiggle room for deals and potentially is another case of Trump escalating to de-escalate. So markets have reacted, I think, fairly calmly given these rates. I think for India, it's interesting that India did not get a letter. And I think that does suggest that a deal could be actually very close and could be potentially on a relative basis quite positive for India. The last thing I would say, Lata, is in all these letters, there was a clause around the tariff rate for transshipments. The tariff rates could be higher, and it does look like the Trump administration is starting to focus increasingly on China circumventing tariffs through third countries, and it wants to really crack down on that.
Okay. Well, somehow this transshipment may not be a very big India problem, except maybe for Apple phones. But separately, back at Nomura, have you all redrawn growth rates for EM as a whole or the world as a whole? Any specific country?
We haven't actually made too many changes. We have had the view for EM and particularly EM Asia that the export outlook is going to darken. There's been front loading of exports, particularly to the US, to beat higher tariffs, and we think there will be payback from that. The other, I think, key aspect of our kind of developed market forecast is that inflation is going to reaccelerate in the US. And I think the CPI report on the 15th of July is going to be extremely interesting. That is between now and the August 1 new deadline for the tariffs. And if we're right and core CPI reaccelerates for the month of June, that could actually throw a bit of a spanner in the works for the Trump administration, because if the tariffs are contributing to that, the leverage or that Trump will have to use tariffs could diminish if it's starting to show some negative effects on the US economy through higher inflation.
Fair enough. Actually, I wanted to start with Chandresh on the dollar, but since you have spoken about core inflation, Chandresh, good morning. Thank you for joining us. Let me start with yields. How do you US yields have kind of, that 4.5 seem to have been the peak. Where do you see the yields headed? There is, of course, the bill as well. And what do you expect Fed to do for the rest of the year?
Thank you, Lata, for having me on the show. I think the market in US is already pricing a lot of negative news in terms of yields. The bill has already passed in US. Market is aware what's inside the bill. So any reaction, negative reaction to the bill should have already happened by now. I think market now is focusing on what Fed does on the policy rate. Market is pricing about 2 cuts for this year and more cuts next year. But in our view, I think 10-year yield will most likely stay in a very tight range, closer to the existing level, but will slowly drift lower towards the end of year, towards 425 on 10-year, and next year maybe closer to 4 to 410 on the 10-year side.
Okay, and you're not penciling in any Fed cuts, therefore?
Yes, so BNP Paribas has been very consistent in terms of the Fed cuts. We have been saying no cuts for 2025 because we think the inflation in the second half in US will actually go higher on the basis of higher tariff numbers, which we are seeing right now. And therefore, Fed will want to remain on hold for the time being and only cut in 2026.
Okay. I'll come to you for currencies, but Rob, what's your sense about the India growth itself? The government and the RBI are working with about 6.5%. Does that sound optimistic?
It seems about right for FY26. We're currently at 6.2% growth. And we are expecting the RBI to cut rates 2 more times this year in September and December. I think the key reason for that is because we think inflation is no longer an issue in India. We think it's going to be below the midpoint of the RBI's target, so below 4% for this financial year. It's currently below 3%. This is a very good combination for India. Growth over 6%, inflation below 4%. I think there's room for the RBI to cut 2 more times this year, and that will also help shore up growth. Very positive on India. I think in the medium term, I talked about this trade diversion. I think if India does have a tariff rate ultimately of around 10%, US tariff rate of around 10%, similar to the UK, that's a pretty good outcome relative to many of its peers. And India could become a magnet for multinational companies to set up for, you talked about iPhones, but I think there's a lot of room for toys, textiles, footwear, electronics more broadly. I think India is going to be in a strong position to become a bigger manufacturing hub if it turns out on the more positive side of US tariffs relative to many other EM economies, including China.
I want to take issue with that argument because of some doubts, but let me get Chandresh in on just the dollar and finish the dollar-rupee argument. Indian yields have never been this close to US yields. If you take the 10-year, less than 2 percentage points often, the difference between the two. Likewise, inflation rates, never have we converged so much with US yields. So your view on dollar, first of all, I mean, is 97 or 96.8, or does it drift towards, below 90? What's your thought? And dollar rupee as well.
I think we are in a general environment where dollar is heading lower. I think we need to understand why it's heading lower. There are 2 kind of flows which are happening right now. One is the flow from the economies which are current account surplus, such as Europe, Japan, Korea, Taiwan. They are sitting on massive US assets in terms of US equities and in terms of US fixed income. So these countries are now trying to hedge their US assets and by selling dollar forwards. And that's why across these markets, if you observe, forwards are very low. A second flow, which is impacting DXY, is the diversification flow, where people are trying to think what else we can buy apart from US assets. So they're thinking about European assets, Korea assets, India to some extent, and China to some extent. Both of these will push dollar lower to some extent. In fact, we are saying that in the next 1 year or so, DXY may be lower another 3 to 4% from the current levels. Now, coming to your point on dollar INR, if we understand India, India is a current account deficit economy, very different from what Japan, Korea, or Taiwan is. So they need a current account surplus to balance the balance of payment. Now, on the capital account, we only have bonds and equities, where bonds are actually not seeing much inflows. In fact, RBI recently indicated they are probably done with a cutting cycle. We also believe so. Bonds are not really getting too much of inflow from the foreigners. On the equity side, there's some dividend outflow which is happening, which is a seasonality in the next 2 months. Again, it's a dollar outflow. Then India has been buying a lot of defense and military equipments as well. That's why we believe dollar INR will come down, but it will not be the outperformer versus the other currencies like euro and others.
Fair point. Rob, to come quickly back on the issue that you raised, Trump has set the tariffs, but he seems like he'll be whimsical about non-tariff barriers. As well, for a businessman, that makes a big difference. So will we really be advantaged by the tariff difference? At the moment, that's the big thing India is waiting for. But the uncertainty looms. What's your guess?
Yeah, the uncertainty definitely looms right now, Lata. But I mean, where we stand, looking at what the Trump administration's done, they've got there's no real trade agreements. I mean, these are frameworks at the moment. It looks like still the U.S. tariff rate on China is over 50% when you add it all up. Japan seems a fair way away from a deal. The EU will see, also concerned about non-tariff barriers. I still think India, as an emerging market economy with a very large domestic market, is in a pretty good place and can benefit from this trade diversion over time. It's not going to happen overnight. I mean, for FX, I would tend to agree that I think the dollar is going to continue to soften. It's not like US exceptionalism is structurally over, but I think there is a move from the US economy to becoming a bit more of a normal economy, and investors are maybe doing more FX hedging and maybe incrementally buying a bit less US dollar assets. India, I mean, even with 2 rate cuts, we do think dollar INR can go lower. We think it could go a bit below 84 by the end of the year. And that is, partly on the basis that, yes, rates are coming down, but they are still relatively high in India compared to most other big economies. Yeah.
Point. Okay, thank you very much for an extremely useful conversation in a situation when there are so many moving parts. We will touch base with both of you when you're obliged. Thank you very much, Rob and Chandresh, for joining me. Wrap up on Bazaar. Chart Past is coming.